Have you ever felt overwhelmed by the complexities of investing? Do you dream of growing your wealth but don't know where to start? John C. Bogle, founder of Vanguard and author of The Little Book of Common Sense Investing, dedicated his life to making investing accessible to everyone. He believed that you don't need to be a Wall Street whiz to achieve financial freedom. Bogle's book is, honestly, a beacon of clarity in a world often shrouded in financial jargon. It cuts through the noise and provides a straightforward roadmap for building wealth over time. His central message? Keep it simple, keep it low cost, and stay the course. This book isn't about get-rich-quick schemes or trying to outsmart the market. It's about harnessing the power of long-term, disciplined investing in a way that benefits you, not Wall Street. In the following sections, we'll break down Bogle's timeless wisdom into actionable steps you can take to unlock your financial future. Let's embark on this journey together and discover how Bogle's common sense approach can empower you to achieve your financial goals. Bogle's investment philosophy can be summed up in one powerful concept: index fund investing. This idea, though simple, has revolutionized the way millions of people approach building wealth. Instead of chasing after the latest trends or trying to outsmart the market, Bogle encourages investors to focus on what truly works over the long term. This strategy forms the bedrock of his book and is the key takeaway for any aspiring investor. It's a method that strips away the noise and distractions, allowing you to concentrate on steady, reliable growth. Instead of trying to pick individual stocks or outguess the market, Bogle advocates for a simpler approach, investing in low-cost index funds that track the overall performance of the market. These funds are designed to mirror the returns of the entire market, rather than betting on a handful of companies. This strategy removes the guesswork and complexity often associated with investing, allowing you to capture the market's long-term growth potential without the stress of constant buying and selling. It's a way to invest with confidence, knowing you're participating in the collective progress of thousands of companies. Think of it like this: instead of trying to pick the fastest horse in a race, you bet on the entire field. You're not relying on luck or special insight. You're trusting in the power of the whole. This way, you're guaranteed to win as long as the horses keep running. Over time, the market as a whole tends to rise, and by owning it all, you share in that upward journey. Similarly, by investing in the entire market through index funds, you position yourself to benefit from the continued growth of the global economy. Your investments grow as the world's businesses innovate and expand. This approach might seem counterintuitive at first. Many people believe that to win big, you have to take big risks or find hidden gems in the market. After all, don't we all dream of picking the next Apple or Amazon? The allure of striking it rich with a single stock is hard to resist. While individual stock picking might seem enticing, it's a strategy fraught with risk, especially for those new to the investing world. Index funds offer a safer, more reliable path, one that has helped countless people achieve their financial goals with less stress and greater peace of mind. What exactly are index funds, and why do so many financial experts, including John Bogle, consider them a cornerstone of smart investing? To understand their importance, let's take a closer look at how they work and why they're so central to Bogle's investment strategy. Let's break it down in simple terms, so anyone can grasp the concept, even if you're new to investing. Imagine the stock market as a giant pie, filled with all sorts of flavors, each representing a different company. This pie represents all publicly traded companies, from tech giants to small retailers, all mixed together. An index fund is like buying a slice of that entire pie, not just a single flavor, but a little bit of everything. When you invest in an index fund, you're essentially buying a tiny piece of every company in that index, giving you broad exposure to the market. For example, the S&P 500 is an index that tracks the performance of 500 of the largest companies in the United States, including household names like Apple, Microsoft, and Amazon. When you invest in an S&P 500 index fund, you're spreading your money across all 500 of those companies, mirroring the performance of the overall market rather than betting on just one or two winners. This diversification is, honestly, one of the key advantages of index funds. It means your investment is not tied to the fate of a single company or even a single industry. By spreading your investments across hundreds or even thousands of companies, you reduce the risk of putting all your eggs in one basket, which is a classic mistake many new investors make. If one company performs poorly, the impact on your overall portfolio is minimized because the other companies can help balance things out. Moreover, index funds are incredibly easy to manage. You don't have to constantly monitor the market or make complicated decisions about which stocks to buy or sell. Unlike actively managed funds, where portfolio managers constantly buy and sell stocks trying to beat the market, index funds simply follow the index, making them much more straightforward for everyday investors. Index funds simply track a specific index, automatically adjusting as the index changes, so you don't have to lift a finger. This passive approach results in significantly lower fees, since there's no need to pay for expensive research or frequent trading. Over time, these lower fees can make a huge difference in your long-term returns, helping your money grow faster and more efficiently, which is exactly why index funds are such a powerful tool for building wealth. We've all heard stories of legendary investors like Warren Buffett, who consistently outperform the market. While these stories are inspiring, they often give a false sense of attainability. The truth is, consistently beating the market is incredibly difficult, even for seasoned professionals. Countless studies have shown that the vast majority of actively managed funds run by highly paid experts fail to outperform the market over the long term. This is because trying to predict which stocks will go up or down is like trying to predict the weather months in advance. It's nearly impossible to do consistently. Furthermore, even if a fund manager does manage to beat the market one year, there's no guarantee they'll be able to repeat that success in the future. The market is constantly changing, and what worked yesterday might not work tomorrow. Bogle understood this fundamental truth. He knew that instead of trying to outsmart the market, the smarter approach was to accept market returns and focus on what you can control: your investment costs. This brings us to one of the most crucial aspects of Bogle's philosophy: the importance of low fees. Have you ever wondered how much you're actually paying in investment fees? It's easy to focus on the big numbers, how much you've invested. or how much you hope to earn, but the small print about fees often gets ignored. It's a question many investors overlook, but it's crucial to understanding the long-term impact of fees on your returns. Even a seemingly tiny fee can quietly eat away at your wealth year after year. Let's say you invest £10,000 and earn a 7% annual return. Sounds great, right? Over time, that money could really grow, especially if you leave it alone and let compounding do its magic. But what if you're also paying 2% per year in fees? That might not sound like much at first glance, but it's more significant than you might think. That 2% might not seem like much, but it can significantly erode your returns over time. Instead of your money working for you, a chunk of it is quietly siphoned off every single year. Over 30 years, that 2% fee could cost you over £30,000 in potential earnings. That's money that could have stayed in your pocket, growing and compounding for your future. This is why Bogle was so passionate about low-cost investing. He saw firsthand how high fees could quietly drain investors' wealth, and he made it his mission to change that. He understood that even seemingly small difference in fees can make a huge difference in your long-term wealth. Over decades, a 1 or 2% difference can mean retiring earlier or having more to spend in retirement. Index funds, due to their passive management style, typically have significantly lower fees compared to actively managed funds. They simply track the market, so you're not paying for expensive research or constant trading. This is because you're not paying for expensive portfolio managers to pick stocks. Instead, your money stays invested, working for you, not for someone else's bonus. By choosing low-cost index funds, you get to keep more of your hard-earned returns. That means more money for your goals, your family, and your future. Remember, when it comes to investing, every penny saved in fees is a penny earned in returns. Over the years, those pennies add up to pounds, and those pounds can make a real difference. Over time, the power of compounding those savings can make a world of difference in your financial well-being. The less you pay in fees, the more you keep, and the brighter your financial future can be.